It's 11 o'clock and we're, I think, ready to go. So same thing is slightly different this week. So we're going to be doing news as usual, and then we have a panel which we do every month, but we're talking about active ETFs this time. And so because it's on that topic, we've got my colleague David Batchelor is going to be hosting it. So news-wise in the investment company sector, as you might expect, I'm going to be talking about Saba a bit, and then we'll just give you some updates on a couple of stories that we've covered in previous weeks. Edinburgh Worldwide then, there's the chart. Doesn't look great, we know that. But that really, and this is important because I think it covers an awful lot of trusts. There were an awful lot of things that ran up on the back of the slashing in interest rates and the easy money stuff that happened to stave off COVID. So you get this enormous kind of rise up and then retreat again in 2022 when interest rates go down. And that is common to an awful lot of things. But in the 5-year numbers, and this is a 5-year chart, what you're getting now is only the tail end of the rise and all of the fall. So these numbers are looking really bad now. But do remember, if you look back a little bit more, then these numbers don't look quite so bad. Now, obviously, the other thing that chart tells you is that Worldwide's discount got way too wide, and everybody's acknowledged that that was a problem, and then came rattling in again, really on the back of Saba buying it, and then announcing that it had great plans for it, and we're going to talk about that in a minute. But since that incident, the discount's been very tight. And it's currently only 4.3%. So, acknowledging that there was something wrong, the board of Worldwide did act last year. They said, we need something to change. They talked to Bailey Gifford. There was a shake-up of the management team. They agreed to hand back £130 million over time, and they changed the investment approach. And that plan was put in front of shareholders, and they were asked to approve it, and they did overwhelmingly. So 99.4% of those people that voted said, yes, this is a plan that we can get behind. But on the same day, Saba announced it had requisitioned a meeting to remove the board, stick in its own directors, and take control of the thing. And they had this grand plan to knock it together with a bunch of other things and run it themselves. But actually, with this one, they mucked up the paperwork. And so because of that, it did get done eventually. It was the last one of these things to get voted on. So it was done on Valentine's Day this year. And overwhelmingly again, shareholders said, no, we don't want your plan. And although the vote doesn't look, it looks a lot kind of closer, of that 36.2% that voted in favour of Saba's proposals, almost all of that was Saba's money, because obviously it bought lots of shares to try and railroad these things through. And the other shareholders said no. So they've published a letter on the 27th of November saying we've written to the board and we want change. We're going to requisition you again. And in it, they compared the returns of Edinburgh Worldwide to the all-share index, which is completely daft, as we know, and also said the company hasn't been buying back enough shares. So because of that, we say you're failing, and we're going to kick off the entire board again and stick in our own people. But these are independent directors these times. So then, basically, the last time round, one of the people they were putting forward was actually a Saba employee. I think now this time around they won't be, but we still don't know who these people are because the actual requisition hasn't been put in yet. Now, not surprisingly, everybody just kicked off again, and the board made this statement. And the important things here are all shares, obviously, the very completely wrong benchmark. And you wanted us to change stuff. We have changed stuff. We already had that in place before you got involved. And it's working because if you look at the performance of the fund since they reset it, relative to the proper benchmark, which is the S&P Global Small Cap Index, it's way ahead. And so obviously, these things take time to come right, but it is already coming right. And so from a performance point of view, you wanted stuff to change, it has changed and it's working. And then when you come to the discount side of things and the buybacks, what's the point of buying back stock? What's the point of not being the company buying back more shares than everything else if your discount's already narrow? And it is. I mean, they said 5.6, 4.3 this morning. It's a lot narrower than the peer group average. I mean, there's an argument for saying it's too tight. I mean, I'm not saying that there's something wrong with it, but I'm saying there's an argument for saying what's the point of buying back stock at all at this level when you get down to sort of 4%. Given the uncertainty, there is some uncertainty around the valuation of the unlisted stuff. Why? It starts to not make sense to buy back stock, but nevertheless, the board are doing that. So it's going to be interesting to see who signed up to be a sub-nominee, because when I was in Edinburgh a couple of weeks ago with AIC, there was a lot of talk around there, like that people had been approached and said no. So it's going to be interesting to see who said yes. But the other thing that we'll be looking for is if they do want to kick this whole thing off again, have they actually got a real plan? Like, is there something that's much on the table that is much better than outperforming the global small cap index by 10% over 12 months? If it's just give us the contract and we'll do something wonderful with it, or give us some money back at NAV, then I think there's a very good reason why shareholders, including me, are going to reject it. So my plan, unless they come up with something amazing, is just to vote against it. And the only reason it could win is because people don't vote. And there's a question here from Normbite, so basically saying, are they the reason the board took action? There's got to be a question whether the board would have done anything if Saba hadn't appeared on the register. I think that's reasonable, but they did do something and it is working. So there's no reason to change the board. There's no reason to stick Starbucks stooges in. Definitely, everybody's got to just rally around and vote against, and then say, mate, you've tried this before, it didn't work, it hasn't worked again. Why you keep forcing people to do this? Because every time they do this, it costs people money, it costs shareholders money, basically. And it's not achieving anything useful. So anyway, we'll see what happens, but we now need to see their actual announcement. On HICL and TRIG merger that we've talked about before, this is the chart. It's a much shorter term chart, just 1 month, just to show you what's going on with the share price there. So that discount has come in a bit actually since the initial shock of the announcement, but that just reflects the ongoing buyback, I think, because they're buying back quite a lot of stock, and that discount is still way too wide. And so many shareholders have come out now, HICL shareholders, saying we don't agree with this. This really doesn't look like a good deal for HICL investors. And they're all listed there on the page. Includes a whole load of private shareholders who went through CEGE Asset Management, the managers of capital gearing, to write to the board. And I think if you want to get involved still and you haven't done, there's still an opportunity to do that. I mean, you can just write independently, or if you actually want to get in touch with the CGAM, you just Google CGAM HICL, and there's a website there. The latest one of them to come out, and it's obviously quite a big shareholder, is M&G, so they've got 3.4% saying we're going to reject the deal. I just, in all consciousness, can't see how the HICL board can plough ahead with this now. And I know they've given an indemnity to the TRIG board, which is a bit daft thing to do, but they did. But in context of HICL, it's not an enormous amount of money, so that I think they should just walk away. If they do want to push ahead with this, then they've got to tweak what's on the table and offer HICL shareholders a cash exit, because there is obviously a large constituency of them that don't want to be invested in a larger fund that's got a whole bunch of renewable stuff in it. This is not what they signed up for. And time and again, and it goes for the cyber stuff too, if you change the investment policy investment approach so drastically that there's a reasonable chance the shareholders aren't going to like it, or some shareholders aren't going to like it. You've got to offer a cash exit. It's just part of what you must do. There's good governance. Polycap Healthcare talking about offering cash exits. That's a good chart, as you can see there. But having said that, although you've got a nice chart that sort of seems to be going up from left to right there, this case for investing in healthcare is still very much there. And I know we've had a good bounce recently, but relative to a whole bunch of other sectors, healthcare's struggled a bit. And it obviously markets have been going up generally, but healthcare has been lagging, and I know it's catching up a bit now. The whole reason why we said you've got this cash exit opportunity, don't take it, is because the time is not right. And that again is another big thing about any of these potential sell votes. Again, don't just rush for the exit because you've got a discount narrowing opportunity, especially when the discount narrowing opportunity isn't that big as it was. This was the case in Capital Healthcare. So 100% exit opportunity on the table at more or less NAV, more or less. Actually, only 22% of the shareholders tick that box. So it's definitely big enough to carry on going, which is great. And it's still possible because we don't get the final announcement yet. The next phase of this was to see if some of those shares could be placed with new investors, because if you want to make a big investment into a trust like this gives you an opportunity to do it. Obviously that 22.47% of the register, there's an opportunity to buy that entire block if you like, and it comes at a very small discount to the NAV. So it is possible that they'll sell some of those on. Fingers crossed that happens, but nevertheless that was a good result. So on a bit of good news, I will finish up there and I will hand over to David. So we're going to be talking about active ETFs, the present and the future, and we've got a good panel of people to come and talk to you about that. So that's enough from me. So Iman, you can now bring everybody in.
Great. Yep. Thank you very much indeed, James. Yes, I am very pleased indeed to be this morning hosting our first panel on European active exchange traded funds, titled The Present and the Future. I'm Quoted Data's active ETF analyst. This is clearly a very fast growing market on which we published a full length piece on our site earlier in the week. And at Quoted Data, our aim is to provide research and insight into the sector, which wealth managers and private investors can use to support their decision making. Now, when most people hear ETF, they probably think of a passive fund that tracks a particular index, and that is certainly what they have traditionally been. However, active ETFs retain many of the benefits of the ETF structure in terms of liquidity, transparency, and trading very close to NAV, generally at a pretty low cost, but they introduce an active management element in an attempt to outperform, often being focused on a particular theme or asset. Now, the active ETF market in the US is pretty huge. And while in Europe we've been some way behind, the market over here is growing quickly, and indeed more quickly now than in the US. Now, as we go through the discussion, please do post any questions or comments you have for me to put to the panel, which I will introduce now. Our esteemed panel, we have three people joining us. Thank you very much indeed to all of you. We've got David Ricketts, who's the Asset Management Correspondent at Financial News, Paul Lacroix, the Head of Products at OSSIAM, and Michael Moore, the Global Head of Xtracker Products at DWS. So firstly, I'm going to invite each of them to introduce themselves and to let us know how they fit into the active ETF market. So if I could start with you, please, David.
Yeah, thank you very much, David. So I am the asset management correspondent, as you said, at Financial News. So we cover the breadth and depth of the financial services sector, and my focus very much is on what firms are doing in the asset management space. And ETFs has been something I've been covering for the last probably 10 or 15 years, and it's been really interesting to see the evolution of the market, both in Europe and in the US as well. As you say, the US market is absolutely huge, and it's always kind of sort of seen as the market that's more mature, if you like, than the European market. And I think when I cover asset management, it's been interesting over the last sort of 18 months to see the rise of active ETFs, because a lot of new players come into this market over the last year or so. Schroders, Royal London, M&G, Jupiter, Aberdeen, just to name a few. I mean, these are all kind of active houses that, had I asked 4 or 5 years ago, what's your view on ETFs? It would have been, well, this is an index area. This isn't anything we're going to get involved with. But it's been really interesting to see the rush of active managers into this space. So I'm coming at this as very much as an observer. So I'm happy to give you my kind of views and opinions on what I'm seeing, and discussions with asset managers and what they've been telling me about their plans for ETFs. But it certainly is one of the most exciting and fastest developing parts of the market that I'm covering at the moment.
That's great. Thank you very much. Paul.
Yes, hi everyone. Thank you for inviting me. So I'm Paul Lacroix, I'm head of products at OSSIAM. So for those who might not know OSSIAM, we are the ETF branch of Natixis. We are based in Paris. We launched the company back in 2009, and of course we produce ETFs. Of course, active ETF is a big topic, even more lately than the past few years. We started our story with active ETF in 2018. When we launched our first active ETF in Ireland. And since then, of course, we saw the growth of that specific area of the market, which is very convenient for an asset managers. So very happy to discuss about this topic with you.
Great, thank you very much. And finally, Michael.
Yes, thank you, David, and hi, everybody. So my name is Michael Moore. I'm working at Xtrackers, which is part of DWS Asset Management and Deutsche Bank Group. I'm here responsible for, well, pretty much all Xtrackers products. So that's exchange-traded funds, but also exchange-traded commodities, investing into gold, cryptocurrencies, etc. Yeah, I've been in that industry actually since the late 90s, and I joined the ETF industry back in 2009. And I always used to say we do pretty much anything that is tracking an index with our ETFs. So, like the MSCI World's S&P 500s and Euro stocks of the world. We had one exception, which was already back in 2009, where we launched, well, what is an active ETF today? But back then, this concept didn't really exist, right? So it was just an ETF not tracking a benchmark. And obviously, especially during the past 2 years or so, I had to change my narrative. And now we're no longer looking after anything that's tracking a benchmark. We are really more and more just looking at ETF as a platform to bring, yes, benchmarks, but also a lot of other very interesting strategies over to our investors.
Fascinating. Thank you so much. And thank you again, all three, for your time. Now, I'm hoping to have a sort of a freewheeling discussion with you here. I've got a few topics that we can touch on. I thought we'd start, given the title is present in the future, we'll start on the present. The current state of the market, how much interest is there from investors, and where is the marginal buyer in this sector coming from at the moment? Would anyone like to kick off there? Perhaps David, with your sort of your journalistic hat on.
Yeah, absolutely. So I would say probably, in discussions I'm having with asset managers, I think the kind of attractiveness of active ETFs, as I say, certainly grown over the last 12, 18 months. I think if you look at the German market, I'm sure Michael can probably give more information on this. That seems to be booming in terms of flows. Whenever you look at the kind of the flow data on a monthly basis, if I speak to asset managers about what's driving those sales, it really is kind of in the German market, where a lot of the online brokers, the retail savings platforms that have been set up there over the last couple of years are really kind of getting interest from I suppose maybe younger generation of retail investors as well. So I'm not sure whether I'd call it a retail revolution, but I think certainly the ETF wrapper, if you like, does kind of gravitate towards a younger investor. There are people that potentially like to trade using their mobile phones. I guess the older cohort of investors who are probably more traditionally used to mutual funds would probably not the main target market here. But I think last count there were about 10 million of these online savings plans in Germany. So I think Germany in particular is a huge market for ETF players at the moment. But I suppose the other attractiveness of an ETF is the low cost, the transparency, the fact you can trade intraday. So again, going to that kind of message about the next generation of investors, I think there's a kind of an expectation that if you trade something, you want to do it immediately. If you want to settle a trade, you don't have to wait 2 days for your money to come back into your account. So I think the kind of immediacy, the flexibility, the transparency as well that are offered by ETFs, I think that's something that's a real selling point. And like I said, a lot of the asset managers who I speak to, 4 or 5 years ago, probably wouldn't be necessarily interested in ETFs. But I think if you look at the kind of the journey over the last 4 or 5 years, active managers continue to underperform the benchmark on the whole. It's very rare that you'll find an active manager that has consistently outperformed. You might find one, but it's very hard to find one. So I think actually a lot of active managers are now getting involved because they feel they've missed the passive boat. And given the interest in the ETF wrapper, they don't want to miss this second wave potentially. So it's a good way of them to package up existing strategies into a wrapper that's gaining more popularity. So I think that's where asset managers really see the kind of push, if you like, to get involved in this. Otherwise, they're going to miss the boat the second time around, I think.
Maybe if I can just comment on this, the ETF is not going to solve the performance issues. It's not because you put the active strategy into the ETF format that you solve everything. Of course, the cost will help. I just checked the numbers. The average fees in Europe for active ETFs in equity space is 37 bips. Compared to 1.32, so 132 bips for mutual funds. So of course that will help. And a big reason of why active managers are underperforming is the fees. And maybe just to define a little bit more what we hear about active ETF, because it's still kind of a niche in the full ETF space, at least in Europe. In terms of numbers, that's a bit above 60 billion in Europe. Which grew quite a lot, but it's only 3% of the total market of ETF. So compared to the passive, it's still quite small. Maybe another just to comment another point on what we see as active ETF in the market. So you have, I would say, 3 buckets. You have the pure active managers who are just wrapping their active discretionary strategy into an ETF format, which will help regarding the cost, regarding the transparency, liquidity for sure. Then you have the systematic quantitative part in which you apply your systematic strategy into an ETF. That's quite convenient for the manager because you can change a little bit the criteria, like ESG, for example. You can change slightly without changing the index. And the last bucket is more like structured product. We see that a lot in the US, with option overlay strategies. I think there is maybe an echo. Is it only me or?
You're coming through loud and clear here.
Okay, perfect then. So yeah, income and protection strategy into ETF format is quite big in the US, not yet in Europe, but most likely going to come at some point.
That's really interesting, and I think that's a really interesting thing that people need to grasp, is that active can mean different things, can't it, depending on what the product is. It doesn't necessarily mean the way that we would think of active, say, in investment trusts. Active, there's a spectrum, if you like, of how active these things are. I mean, Michael, what about with your experience of how active are the active ETFs that you are involved in?
Yeah, that's actually a very fair question, David. Thank you. And indeed, you mentioned at the beginning in your opening that active ETFs seek to outperform the market, which is true, I would say, from a European perspective for the majority of active ETFs that are currently out there in the market, right? They are the so-called systematic alpha, strategic beta, whatever you want to call it, like the type of products that are relatively close to a benchmark, and then try to generate some outperformance against that benchmark over time. And at lower cost with a systematic strategy, there's a good chance that they will achieve that. So that's the concept here. And that, like this one bucket of the buckets which Paul has mentioned, makes about 80% of the ETF, active ETF volume here in the European market. But it's only a fraction of the market in the United States. So in the United States, you have a lot of products sitting in the other categories. So, and namely, as Paul mentioned, the augmented type of outcome products like the buffer strategies or options overlay, which generate extra income for investors. So these are very quickly growing segments in the US market. And then you have a specificity in the US market where currently also a lot of asset managers in the traditional active space are converting their assets into active ETFs from previously traditional mutual funds. So that means there's also a big volume of, well, let's say traditional actively managed products in the ETF space, right? So, and that obviously makes that market look very different. So the reason why I also say that is if you look into the European market and your question at the beginning about what type of investors are looking in this market and how about retail investors. So our experience so far is these systematic alpha type of products, which follow quantitative strategies, they aren't always the most easy to understand in the first place. Which means the typical users of them are more the professional investor spaces, maybe fund of fund managers and other asset managers allocating their monies into that, or also some institutional investors like pensions or insurance companies, not yet retail. So yes, David Ricketts, you said that as well. The digital or self-directed market, especially in Germany, but I would say all across Europe, is growing very quickly and using ETFs in its growth, but it's not yet using active ETFs. So the share of active ETFs in these digital channels is probably even below the market share of active ETFs currently from that. And the reason is, in my view, that we all have to add more attractive products for retail investors as well that are easier to understand, that are better to follow in the active ETF space. And then you will also see a pickup there.
Yeah, I think it's probably worth maybe pointing out, if some of your listeners aren't familiar with ETFs more generally, is that the US market, one of the reasons why ETFs have been so popular there is that the tax advantage they have over mutual funds as well. So Michael made this point about some asset managers converting their traditional mutual funds into an ETF format. Again, that's a great sort of advantage if you're an investor. But obviously, there's now this move in the US. I think the SEC have now approved the first ETF share class. So that means that managers can potentially launch ETF share classes of existing mutual funds. So we're likely to see more and more ETFs come to market in the US. But I think there are different attractive elements if you're in the US market compared to Europe. And then going back to what Michael was saying about sort of interest from different cohorts of investor, I'm hearing from more and more asset managers that actually wealth managers, private banks are more interested now in active ETFs. So again, that's another kind of cohort where we could see a lot of growth. But yeah, I think this is a really interesting area because I think there's a lot of innovation going on as well in ETFs. I think it's probably one of the most exciting areas to be covering because that's where all the ideas and the kind of research and development is now being directed towards.
Yeah, interesting. You were saying about the conversions to the US. We have seen one over here, haven't we? Middlefield Canadian Income, which converted. So it'll be interesting to see if that starts a trend or if that is a one-off, because as you say, we don't have the tax advantages here. I mean, does that act as a bit of a ceiling to the market over here, the lack of the tax advantages? There must be more to it, the success in the US than just the tax advantages. I mean, presumably there's still a lot of growth that we could see over here, do we think?
Maybe if I can start. I think we usually follow the US path anyway, even without that fiscal advantage, it's still growing very rapidly in Europe. I think the key point is really transparency and fees. So you cannot charge what you were used to charge for mutual fund in an ETF, active ETF. That won't work. The second point, and to echo a little bit what David and Michael said before, I think we need more products for retail in the active space in Europe. I think sorry, the outcome ETF, buffer ETF, could very well be very interesting for that kind of clients through platforms because you know a little bit in advance what you are getting in terms of returns. So that can be very attractive for them. And the last point is, I was discussing with some of our colleagues in the US. There is no mutual fund launching anymore. It's everything in ETF format now. Like more than 90% of the new funds are ETF. Because of the tax advantage, it's so massive there. So most likely we will follow it in Europe. We see more and more classic managers now launching ETFs. Regarding tracking error, so how far you are from the benchmark, that's also a very important point because, as you mentioned, not all active ETF are as active compared to the other ones. It's very different if you have 1 or 2% tracking error compared to, let's say, 8 or more. So even for investors, it's very important to look at historical track record to see what kind of active. Is it very, very active, or are you still close to the classic benchmark?
Yeah.
And I think going back to that sort of demand point, and I remember covering the retail distribution review back in 2014, and that was something that was, at the time lauded as something that maybe would, drive more interest in ETFs because it kind of banned commission payments here in the UK. So, even for the last 10, 11 years, we've been sort of waiting for this kind of wave of interest from retail investors in ETFs. So I think part of the obstacle has been the technology, and I find it amazing even today that some of the big platforms here in the UK market don't have the technological know-how or plumbing in place to actually list ETFs. So it's been a very slow development over the last 10, 11 years. And a lot of these brokers, these new brokers, particularly in Europe, that are launching, can offer ETFs from day one. So I think there's a lot of sort of development needs to go on the platform market here in the UK as well to make these ETFs available for retail investors. So they might be interested, but they can't get their hands on them necessarily all the time.
Yeah, no, that's absolutely true. And like you're talking about access channels, which in my view is like, I'm also convinced that the active ETF market will grow, right? Not least because, as you alluded to before, all the traditional active managers see their second chance of entering into the ETF market, which is why a lot of new products are coming to the market, which is why a lot of marketing money is coming into the market and educating people around active ETFs. So, I mean, in a way, as an industry, we are creating that market, right? And don't get me wrong, there's a lot of good products, but like that market, like we really want it, so that market will be there. I still think there will be a structural disadvantage compared to the US, not only on the tax side of things, but also if you look into the US, a lot of private investors have their like private pension plans and everything, right? Where your money automatically goes into fund savings plans, etc. Unfortunately, in Europe, we're not as advanced yet. We see that across the countries. We see that on European level. Here in Germany, they have the Frühstarterrente, fantastic German word. Like we're discussing all these things, right, to encourage investors to go into that. And with that, there will also be more demand for this type of product. But we're lagging behind there, which is also why I personally think the growth specifically also of active ETFs will be slower compared to the US, will take more time for that and for the tax reasons as well.
Yeah, I think that's a good point. I think actually culturally, if you look at the US market, if you go to the US and work in an office there, if you go and go make a cup of tea in the kitchen, you'll probably find somebody talking about their 401k and what they're invested in, how it's performing. We don't really do that here in the UK. It's still seen as a bit of a taboo subject. You can't talk about your ISA, or maybe the allowance that's been cut this week, maybe. But it's something that's still a bit of a taboo subject. So I think actually culturally, we're not quite there yet. I think education, again, is one of these key points a lot of asset managers talk about. It's educating retail investors about the benefits of investing in these products sometimes. But we certainly don't have that same investing culture yet particularly here in the UK. And we know we don't have the big ads that we have that you see in the US either. iShares and Vanguard and the others. I mean, they're plastered all over the place. We're on TV, but we don't have that same culture here. Maybe that's something that might change and maybe fuel a bit more investment into these products as we go ahead.
Yeah, and in Asia as well, they have those advertisements everywhere for ETF with the tickers, etc. It's definitely not the case in Europe, at least for now. But maybe the young generation as well through platforms, they are still growing quite a lot. And I don't know how it is for the rest of Europe, but in France, given the issues we have with budget and possible retirement issues as well later on, a lot of the younger generation, they know that it would be a good idea to start saving some money, and they are very fond of ETFs. They still look at ETF as the passive ETF for now, but active ETF also has a place down the line for sure.
Thank you. Very, very interesting. We're having a few questions come through, and a theme on a lot of them is ESG, is ethical investing, something we haven't discussed so far. But I think it's fair to say that that's something where active ETFs can have a bit of an edge. It's certainly something that a lot of the providers are pushing. How, that presumably link it to retail investors, particularly young investors. How can active ETFs help with ethical investing concerns?
I mean, I would almost have said in this particular space, it would have helped us had we had, big active ETFs some 3-4 years ago in the market already. Why do I say that? We have seen some players specifically entering the active ETF space because they could apply their own ESG screens and methodologies to the investment universe, and especially also where the universe was changing, right? So there were several changes also from regulators. There was a big improvement of data over time, which you could apply to the securities and then have better methodologies, better screens on your products. And what we have seen as an industry, at least that's my personal perception, is that index providers have been lagging to adjust their index quickly over time. So why they sit, like, the interesting thing is they have all the data, they are selling all that data to us, but they have been relatively slow in improving the indices we are tracking with traditional passive products, right? So I could see that very clear for us here as DWS. There was our active business, which was very quickly moving into very good screens and data, and also different approaches to how they were, or different shades of ESG. Let's call it this way. Whereas on the passive side of things, where we were tracking index, it took more time, and we always had to rely on the respective index providers' data and their availability, and whatever index they could bring out. And like in that world, I think an active ETF would have worked much better, because we would have been able to adjust the products more quickly to regulatory changes, to new data that is available from across the world, and or from across different providers, and make that available to investors. So yes, I think in that space, certainly active ETFs have a bit of an edge, or can have an edge.
Yeah, maybe to echo on that, completely agree with Michael. Actually, when we launched our first active ETF in 2018, that was exactly for this reason, because we wanted to include some ESG, but we knew already that it was going to evolve, maybe every 6 months, every 12 months, and we needed to be able to be quite flexible in incorporating new data, new data sets that sometimes index providers have, sometimes they don't have it, and you can merge basically data from different providers as well. So yeah, if you need an index committee to approve for a change every time, it's not working. It takes way too much time. So I think for ESG, active ETF have a very big edge compared to pure passive, which would be more stable.
Yeah, I think I probably echo what Paul and Michael have said. I think actually, the ESG has been one of these very fast-moving areas. I mean, again, in terms of topics of conversation, again, sort of 4 or 5 years ago, that would have been the number one topic of conversation, ESG, because obviously, post-COVID, the kind of flows into ESG funds was so huge, and I think it has dropped off quite considerably since. But I think you're right. I think some of the regulation that's come through over the last couple of years has meant that asset managers do need to adapt pretty quickly to those changes. And I think, as you say, if you can adjust things at the margin yourself rather than relying on those indices, then that's a good place to do that.
Yeah, regulation, labels as well. In different countries, everyone has his own label, and that changes every 2 years. So you cannot be stuck with a single methodology forever. It needs to evolve with ESG.
Yeah, I suppose the other point, which I don't know whether we'll get onto, but I guess reliance on indices, and I don't know whether this is going to come up in conversation, but the kind of concentration, if we're looking at the kind of US market in particular, concentration risk there. I know we've seen a lot of products that have been launched, equal weights ETFs, for example, to take out that concentration risk of the big, Mag 7 stocks. But I don't know whether that's an area of kind of potential innovation or development going forward for active ETFs, where they can kind of strip out some of these, risks, if you like, that are being seen in the market. But certainly, when you talk on the passive side, that seems to be an area that a lot of ETF providers are focused on.
Yeah, thank you. And that's quite a good segue, really, because the second part of the title is the future of the market. We could sort of speculating is difficult, hey, but if we could sort of think about how we think the market might evolve, and that's a good place to start. Concentration risk. Are there any other themes or any other ways that we think the market could evolve? Do we just sort of look at the states and say, we're going to be where they are currently? How do perhaps Michael and Paul, as you're involved in products, how are you thinking about evolving your product offering? How do you think that might change in the coming years?
I mean, on our end, look, as Xtrackers, we're like amongst the biggest providers in Europe, and here we follow a certain, let's call it supermarket approach, right? So we want to make sure that we have a product in pretty much on any shelf for any demand that may be there from investors across retail, professional, and institutional investors as well. So that sort of dictates our strategy here, which means we're just going to grow also the active ETF suite, which we have across equity and fixed income, and within the categories from what's currently out there in the market with a more systematic strategy into really actively managed strategies and buffer or otherwise augmented outcome type of products that will be using options, and into the thematic space, really, right? So I see the active ETFs space is sort of growing and will in many areas, we discussed ESG as well, live next to the traditional passive ETFs in a way, and you will see all the shades of these ETFs there as well, especially back to my point before. I don't see the traditional active managers who are now all entering the market. I do not see that they will now, because they have ETFs, also start offering the MSCI World and S&P 500 ETFs, because there's so many out there. They will find it hard to compete. But will they have, to that example, world equity and US equity ETFs and Euro credit and whatever else? Yes, of course, right? And this is why I see this range of products is going to be completed. The question mark then is, which products are investors going to buy, right? So we already have thousands of ETFs. I mean, just go to one of the online channels or the portals and type in your desired product you want to buy, and you always get a very long list of ETFs, and then enjoy selecting the right one, right? And do not always go by TER only. There's other things, but that's not for today. And then the question is, what are they going to buy? And here we come to the point we made before, performance, right? The active ETFs that are there to seek out performance versus a traditional index, the ones that really achieve that and they are good, they will get money. Just like, if we're honest, it happens today in the traditional active world. I mean, the traditional active products with good performance after fees, they collect money, they win a lot of money, and we are very jealous from a passive perspective looking at that, but they deserve it because they are doing a good job. And you will see that in the active ETF space as well. The good products will make their way. They will attract investor demand for sure.
Really interesting. Paul, what about you? change.
Completely agree. We are not as big yet as TWS. Hopefully one day we will be. So we also have a lot of different products, the classic one and the active ones. Maybe just to maybe follow on one point, which is the thematic. There is a lot of interest from everyone about thematic. The issue is that it's difficult to launch everything as an ETF provider. So maybe having an active ETF on thematic, which would be able to switch between different themes depending on the market conditions, would allow to have the good thematic at the right timing. We saw it about defense this year, lots of interest, but it was potentially already too late because the rise of the defense stocks in Europe already happened. So in order to be before the investors, before that market, be ready, the active and rotation can help in that area. The second point that we see a lot as well is requests for white labeling. So it's maybe a bit of an extent here, but a lot of providers, like classic mutual fund providers, they don't have the ETF format and platform. It's actually quite costly. There are a lot of specificities for the ETF, and it's not that easy to access. And some of them would rather launch strategies using an existing platform. So there are a lot of providers, including us, that can do that. And I think that's also a very big topic. We saw an acceleration over the past 2 years when we receive requests basically every 2 weeks. So it's really growing as well.
Yeah, I think that's a really good point. I think competition already in the ETF market is incredibly fierce. I mean, it's very hard to compete with the large players in the passive space. And if you look at the active space, I mean, it's a completely different set of players who are kind of top 3, top 5. But I think the kind of the race is on now to get these products out. I think as Paul mentioned, particularly on thematics, it's kind of that ability to launch products at the right time and before the kind of the curve, before it's plateaued, because it is often too late once you're in those thematic products. But I think it'll be really interesting to see as well how a lot of these asset managers approach this from a sales perspective as well, because a lot of the traditional mutual fund providers will say, okay, well, we'll just hand these products over to our existing sales team, for example. And I just wonder whether you can actually sell ETFs if you're a sort of a traditional mutual fund provider, if you need a separate team with different expertise and skills. I think that's one particular area of interest. But I think the point that Michael made about performance as well, that will be key. I think if managers can prove that they can deliver above an index, a bit like a mutual fund, a track record is always great. Then I think these products will take off. But I think it's such an interesting area. It's a fledgling area. It's an area that a lot of asset managers are getting involved in now. But I think the growth potential shoes. I was talking to JP Morgan, who are the largest active ETF provider in Europe, and they expect the market to grow to, I think, 400 billion in Europe by 2030. So that's up from 60 billion last year. So those are kind of the figures they're talking about. So yeah, there is money to be made in these products, and I guess there are investors sitting on the sidelines waiting to get in. It's just waiting for the right products to come to market.
Do we think there'll be particular challenges if we do see this explosive growth? I mean, you've already mentioned that providers perhaps need to up their game in terms of making things more user-friendly. Are there any other challenges we should be aware of in a growing market?
I mean, what I always say is we as a financial industry, with the ETF wrapper, we've been able to create something over decades now, which is successful. And you alluded to it before. They are known, they have a reputation to be transparent, liquid. They do what they promise you to do at any, also in very difficult market trading times. So we have created a strong brand, if you wish, a very trusted product across all providers. Great. The risk I see a little bit is that I'm not a big fan, for instance, of semi-transparent products. And Paul, I think you mentioned that as well, like transparency is key, pricing is key. And we also do not see the semi-transparent products really picking up in the US. Maybe for those who are not that familiar with how it works, semi-transparent means that a typical ETF would disclose its portfolio on a daily basis to the entire market. Everybody knows what's in, you know what the fair price is, it can be easily traded, very liquid, etc. The semi-transparent products wouldn't. They are more like active products that would disclose on a whether every other week or on a monthly basis their portfolio. And then obviously it's less transparent to the market what is in it at a given point in time. The good thing is you can have some really juicy trades. The bad thing is you don't know what is in, right? And this is my worry a little bit, that we now obviously have many entrants into the market that have nothing to lose. For them, they made zero money from ETFs over the past decades. Now they hope to make money from ETFs in a very competitive market. So quite naturally, you are ready to take some more risk than maybe people like us, for instance, who have a lot of revenues to lose from, if we get it wrong on ETFs. And this is something where if there's over promising, if there's too much risk taking, I don't think there will be too expensive products because, well, this is something the market will manage to do, but the products don't deliver the performance they have. And a big risk also, if there's market turmoil again, if there's liquidity squeezes, like we have seen that when the war happened, for instance, in the Ukraine, or before in China, there have always been times where the liquidity drained a lot and where you have seen the good ETF setups and the bad ETF setups in terms of what continued to trade at any point in time and the products that stopped trading. And this you are also going to see, because an ETF is not just a listed fund. Behind an ETF, you have a lot of infrastructure and data and providers in the value chain that assure that there's liquidity at any point in time. And you already now see certain setups that are more robust than others in the market, and crisis will show if really all of them are there to stay. Right? So that to me is the biggest risk, if you wish, for the ETF and the active ETF provider. We as an industry, if we don't continue to play ball and keep the high quality of that ETF wrapper up, then we are a threat to our own products.
Yeah, I think that's a very good point, Michael, because actually you said it there, the ETF industry has a very solid reputation, and I think regulators over the last 10, 15 years have looked into ETFs in various ways. So I think the Central Bank of Ireland looked into it, IOSCO, ESMA, and either is it synthetic ETFs or was there enough? How do they perform during bouts of market volatility, whether it's Brexit, COVID, and there are various other market points where the ETF has been real scrutinized. And actually, throughout all those episodes, ETFs have always managed to perform and got a seal of approval from regulators. So I think you're absolutely right. I think this kind of new era, if you like, for ETFs, when we're getting a lot of experimentation or different kind of product being launched using the wrapper, that's a potential risk to the brand, which is something maybe to consider. But you're right, the ETF reputation has been pretty solid up until this point. So it'll be a shame if anything does happen to jeopardize that.
Yeah, maybe to finish on this point, we don't have as much market makers in Europe compared to the US market on the exchange. So it's a very different kind of market. And if we have a lot of active managers starting to launch ETF in Europe, we will need probably more infrastructure to actually have good pricing on the exchange regarding bid-ask spreads, for example. It's, of course, much more difficult for them to calculate what should be the fair price of an actively managed strategy that can change during the day compared to a simple MSCI World or S&P index. So that will be a challenge, and the more active managers going into the ETF format, the more difficult and the more infrastructure we would need for, especially liquidity providers on the different exchanges.
Yeah, and if I maybe add to that, because I had a very interesting discussion with our fixed income portfolio manager. So infrastructure is definitely a big thing, the number of providers, the data flows, etc. But also the the portfolios must be made for purpose. So that was my point before. An active ETF is not just an active product listed on exchange with a couple of brokers working on it. When we speak to our fixed income portfolio managers to launch the next corporate bond active ETFs, etc., we are educating them a lot around how their portfolio has to look like. And I consciously say, I do not want your hidden juicy trades in an ETF. Keep these for the active portfolio and for the, for the investors there who can live with less transparency and who appreciate that. And an ETF, I want liquidity, I want scalability. This is what I need to also survive the not so good market periods. And this type of education happens quite naturally in our house because we have ETF people and active managers all with like 50 years of history. But other houses that have less experience in the ETF world and that haven't lived through liquidity crisis in the ETF segment, they may make the mistake of translating their very good active strategies, simply carve it out, put it into a passive in an active ETF portfolio and list it on exchange. That works well as long as markets are good, but that can become problematic when there's liquidity constraints in the market, and that is something to be seen. So it's also about the portfolio construction itself that has to be made for purpose, made for active ETFs.
Fascinating. Thank you so much. Had another question through here. It's probably going to be the last one we have time for. Noting that within the sector, there's a lot of funds that are absolutely tiny, that really are small. There's quite a long tail in this sector. Is that just a function of a growing market? I mean, are a lot of these smaller ones just inevitably gonna go by the wayside, or is that something to be concerned about, or is that just inevitable? Anyone have any views?
Maybe I can just give some ideas here. People think about ETF as being very cheap, and that's true for the TER, but actually to run an ETF, it's much more expensive than a mutual fund. So you cannot live with very, very small ETFs. They won't make money for the asset managers. So most likely an ETF, active or passive, which is very small, at some point it will have to go because it's just not worth it. So yeah, important to keep in mind. ETF is cheap, but not necessarily for the asset managers. So yeah, a lot of people are trying new products, but at some point, yeah, if it's not picking up, we cannot keep it forever. And that's true for passive and active, to be honest.
Yeah. No, I guess in the meantime, a lot of choice for investors, and that's inevitably be survival of the fittest, right? That's kind of how we want the markets.
Yeah, investors decide, right? That's what I always say in the ETF space.
Yes.
Products are bought, not sold, which is different in the active world, right? And here it's much more, as you say, survival of the fittest here, which is nice for investors, tough for asset managers, but probably overall good for the market. It's very healthy, right? There's a reason why ETFs have a good reputation and a solid reputation over so many years.
Yeah, that's right. I think actually, when it comes to the industry more generally is under a lot of cost pressure. Some of those smaller funds are the ones that do get culled on the active traditional side. When an asset manager is taking the axe to costs, it's looking at those funds that are they subscale, are they worth continuing with? Is demand there? If they're not, then they get rid of them. So yeah.
All right. Fascinating. Well, we're very nearly at midday. I don't know if there's any final points anyone has, or that might be a reasonable place to end it. I think that was a absolutely fascinating discussion. Thank you. I certainly have learned a lot in the last 45 minutes, and hopefully our viewers have too. Just leaves for me to bring things to a conclusion with our disclaimer, the important legal bit there, which I'll leave on screen. And then next week, normal service resumed. James will be back going through the news. We've got Andrew McHattie doing his monthly roundup of the investment trust sector, and then we have Tom and Charlotte from Mijo Opportunities Trust, who'll be having an in-depth discussion with James. And with that, thank you very much indeed again to
Thank you very
David,
much.
to Paul, and to Michael. Absolutely fascinating discussion. I hope the viewers enjoyed it. And with that, I'll sign off and say good weekend to everybody. Thank you.
Thank you.
Thank you. Bye-bye.